Good morning. I'm Coursey. I'm the managing partner of TomorrowVentures based in Palo Alto, and I'm going to be moderating our panel this morning on how new investors are changing the landscape in venture capital. We've got a great group here today. Not only my peers, but some of my closest friends, and so I think we're having a really interesting, great time. So let me introduce you to our group today. First, starting to my right, my good friend Troy Carter, who is a talent manager in the entertainment industry, as well as a very savvy tech investor. I just learned this morning one of the things I did not know about him. He started his career as a rapper, which is really, really cool.
I suck though, so that's why I'm sitting here today.
Troy's managed everyone from Lady Gaga to John Legend to Meghan Trainor. On the investment side, he has been an investor in everything from Uber to Spotify. But one of the things I respect most about Troy is he and his wife are one of the most philanthropic couples around, and that's truly, the gold standard in my mind. So excited to have Troy here. We have Kara Nortman. Kara's with Upfront Ventures, which is the largest early stage venture fund in Southern California, and she co-founded an upfront-backed venture called Seedling, which sells toys in 20 countries around the world. Recently launched in Target with a new virtual reality line product coming. Previously, she spent 7 years at IAC, and her early years were at Morgan Stanley and Battery Ventures. Then we have Chance Barnett to my right, who is co-founder of Crowdfunder, and he's also leading the charge with many of the initiatives in terms of investment laws in DC, as well as around the Jobs Act. He's, prior to that, he's been a successful entrepreneur in a number of technologies, for a number of years. And then to my left, we have also a really good friend, and this is the Dave McClure from 500 Startups. Dave is one of the only people that spends more time in an airplane than I do. 500 Startups started in 2009. Let's see, has over 1,500 companies in 50 countries around the world. They've started out with PayPal and Facebook Fund. For full disclosure, besides being a friend and fan to Dave's, we're also, TomorrowVentures is an LP in Dave's fund. And then last, we've got D.A. Wallach from Inevitable Ventures. D.A. is also a great friend, and he's also a recording artist. By the way, his music is some of my favorite in playlists. Highly encourage you to download it. Pretty cool. He's worked with everyone from Kanye West to Pharrell Williams. Just truly amazing, smart guy. He's been an investor in everything from Spotify to SpaceX to Ripple Labs, Doctor on Demand. And DA and Ron Burkle founded Inevitable Ventures last year. So with that said, we're going to actually do something a little different. We're actually going to start this off with a lightning round. So we'll start with DA. So bubble or no bubble?
Ridiculous valuations, but I don't see necessarily a buildup of systemic risk in the way that you do in other macro bubbles. So I'm not sure that if these outrageous tech valuations collapse, it hurts anybody who's particularly vulnerable.
Kara?
I think bubble is popping. So everything's coming back to a more rational place, looking at metrics like capital efficiency over growth entirely. So we're still in the process. There's a lot to work through, but I think everyone is acting probably more conservatively than they need to right now. So we're possibly overcorrecting.
Not that much of a bubble, and the air's been being let out for the last year or so, at least in the U.S. Bubble in China.
I think it's overconfidence more than anything else. I don't think big bubble, but I definitely feel like it's going to get chilly outside.
Winter is coming, right?
It's the natural swing. Things have been really hot for a while, so then you see a cool down. It doesn't mean that things are systemically really wrong. And we saw, let's say, a lot less Series A investments in Q1. I think people are a little less ready to pull the trigger. But I also think investors are looking potentially, hey, is there better value out there? What's happening right now? So I don't feel like there's a big retraction. There's just a slowing down and a return to normalcy.
Okay. What do you think in terms of quality of companies that you guys are seeing? Better or worse than 3 years ago?
Worse for me. Like, and as you were talking, that's what I was literally just thinking. It's too much money and too many people starting companies that shouldn't be starting companies. Like people who I think could make great number twos, great number threes are now CEOs of companies.
Ooh. You sound like you really are on the dark side. No, come on, where's the entrepreneurial?
Hey, look, everybody's not an entrepreneur. Everybody's not an
Everybody should
entrepreneur.
get to try.
Not with my money.
Jess, what do you think?
You don't have to give them your money, man.
Wow. I think, look, we've created an environment by creating tools, by AWS. We're basically scaling the ability to hop in and build technology and try something and test something. And like Dave, I love that entrepreneurial spirit. I was someone who put myself through college, had a chip on my shoulder and wanted to be someone, and no one thought I was someone. And I hustled and made it happen. So I love that spirit of entrepreneurs doing that. Do I think there's a lot of capital in the market chasing deals, hoping for something big? Yeah. I think that makes it harder to wade through things and say, who's for real, who's really got the hustle? And you could really only find that out maybe over a year or two after you back an entrepreneur, who they really are if they haven't been through it before. And that's one of my favorite things to invest in, is someone who has the grit and perseverance to make it through those 2 years where it's just a grind no matter how great you are.
What do you guys think?
I mean, I would say that I think the issue is sort of the entitlement around how companies should get started, not that there are too many or too few getting started. I think the idea that you need to get started, get a big salary, and get big equity was one of the problems of the last couple of years. So, signals like I'm willing to leave my job, make no money, scrap around to figure out how to get it started before I bring other people's money in is will raise the quality and the authenticity of entrepreneurs. So I tend to agree. I think there have been too much kind of easy money floating around, too many Me Too concepts, and like that's caused a little bit of intellectual laziness right now on a lot of people's parts to say X is over when it's just been funded in kind of a lazy way with a bunch of people who didn't have to sacrifice to get there, and I think sacrifice is important.
I'm seeing a lot of great stuff. I think the attractiveness of startups has migrated a lot of people who would have gone into Wall Street to Silicon Valley. So any 21-year-old who wants to get rich now by default is going to be a startup founder instead of working at Goldman. But conversely, in addition to drawing a lot of hustlers into this marketplace, I'm seeing a lot of people who previously might have been too scared to start companies taking the leap. In particular, the area where I focus is in the commercialization of science coming out of academic contexts. And I'm seeing a lot of folks who might have in the past been happy just staying on PhD track and maybe meeting some slick business guy who could help them with it, saying, you know what, I can do this. It's easier to access capital. People take me seriously, and I should give it a shot.
I would say definitely seeing better companies all the time. There's a lot more people in the market. I mean, costs have come down dramatically, so there are lots of people becoming entrepreneurs, some who probably shouldn't be, but they're not going to spend that much money failing. You'll probably spend less money than you would on an MBA, and I'd say much better investment to fail at your own startup than to blow money reading about somebody else's success.
Okay, so my next question, two-parter. So besides it being a good idea with great potential return, what's the number one thing that you look for in an investment, and what's the biggest deal breaker? Dave, why don't you start down there?
Biggest deal breaker I'll start with is a low ethical quality of the founders. I believe that I want to be in business with people who I trust and who I want to build a relationship with for decades. And I'm never looking for an exit when I make investments. I'm hoping that all of these companies turn into sustainable cash flow businesses that I can own a piece of for the next 40 years so that I don't need to be making new investments 15 years from now. So that's the number one deal breaker for me. What was the first part?
What's the number one thing that you look for?
Number one thing I look for is, I think, the importance and scale of the market that someone's attacking. It's easy to say that you want people who are going after ambitious problems, but actually maintaining the discipline of focus to only care about and allocate time to those things is very challenging, because I see a lot of really interesting, compelling companies that I think will work, but who are chasing narrow niche, unimportant problems. And if they're interesting enough and if the people are smart enough, I'm really tempted to jump in. But I always have to restrain myself and say, you know what, if I can do 10 things this year, this one isn't a good use of my time.
I'd say I have similar deal breakers to DA, ethics for sure, but then I find in a first meeting of somebody, you can kind of get a sense if somebody starts to talk about exits or I always like to get into really what drives you and what are your goals, and if it's money and exit, and I get that's not for me. It doesn't mean, my job is a pure capitalist. I put money in, I'm supposed to take more money out, but I think the path to get there is a really kind of pure drive for reasons beyond just making money. And then I'd say, big vision, all this sort of stuff, but the number one thing for me is sort of resilience and the ability to, things almost never go as planned, and if you look at most of our companies that have generated more than $1 billion exits, many of them have had near-death experiences. Most of them started off saying they were going to do one thing and ended up doing another thing. And so just the ability to constantly hit against a wall and figure out how to get around it or move through it when you're in your lowest moments is sort of the number one thing I look for.
I think most VCs overestimate their ability to see into the future, and they make decisions. Typically it's product, market, team, and team is most important. It's always about team. And I'm like, you've had 3 meetings with this person. You're going to predict what they're going to do for the next 5 to 10 years based on 45 minutes, 2 or 3 times. That's bullshit. The market's going to change. People pivot all the time. So, we invest very, very early, like 2 to 5 people is the typical company size that we invest in. And, probably 2% of our portfolio gets to a big win that's like $1 billion outcome. Maybe 5% gets to a modest size win that's a $100 million plus outcome. But both of those trajectories are going to be like multiple years of hiring people, choosing a market, changing the product, competing with people, figuring out features and launches, and you're not going to, in one session, look at this person and predict whether they're going to get through that sequence of low probability events. Even for the folks who are fucking amazing, they might still screw up one of those. All you're looking for is some level of traction or capability or expertise. So have they built a product? Have they got a first customer? Do the unit economics look good? Is there a modest amount of traction? All those are points. And you look at the overall package and say, do I feel good about this? Okay, let's put some money down and we'll see what happens.
One quick thing, sorry, jump back in. Dave makes many investments a year. I make 2 investments a year. So,
we did 500 last year.
500? Wow. So I try to meet people months, if not years, before I invest in them, so we can get a sense of, you can give great pitch, but do you actually do what you say you're going to do? Right. So there are slight differences.
The people that you've known for 3 years that you think are awesome, there's 20 other VCs who also know those people who are awesome, and you have to compete to get that deal. Totally. Right? So you're making 2 investments a year, you better be fucking right about those
and the
deals.
first question to ask yourself as an investor is, why me? Right? If it's a Silicon Valley company that knows a bunch of other firms, if you're taking my money, there's something wrong that I haven't figured out.
Troy, what do you think?
I agree with a lot of what the rest of the panel said, alongside of just a deep level of domain expertise. Why are you tackling this problem, and what do you see that nobody else sees? And a lot of it for me is, I think prior to 5 years ago, I never heard the term venture capital before. So for me, it's a lot of feel to it as well, and just kind of getting a sense for that entrepreneur.
Yeah. But you're probably picking winners in the entertainment industry for 5, 15 years.
And it's a lot of similarities, by the way.
Truly identifying talent.
It's that it factor.
I met DA in a living room of a house party, and we were on a club tour. We were launching Lady Gaga, going to nightclubs. And we were looking for opening act, and it was a band playing in the living room, and it was DA.
That's awesome.
And literally a few weeks later, you were on tour with us?
Because of Troy, she was so successful, they had to add a second show every night. Wow. So I lost my voice 15 times on this tour.
Well, we recognize talent.
Yeah, that's awesome.
So I guess I have two answers to that, because there's Crowdfunder and our fund and that model, and then my personal investment model, and I like to make angel investments. On the personal side, I look for founders that have that grit and perseverance, because I know they're going to hear no. I know that great VCs that maybe should have invested, like Brian Chesky from Airbnb, who got turned down for $500K in his seed round at a $1.5 million valuation.
I
and
fucked
now
up
it's
that
worth
deal.
many billions. You can't tell everything, so I like investing in people that I know are going to persevere and make it through no matter what. Those are great odds. I also like people who really have some special sauce, and you can never put your finger on what it's going to be when they come in and talk to you, but you know it when you start to hear it. It could be an esoteric PhD that they got from a school that in some really orthogonal way applies incredibly to the startup that they're building, and you never know what that is. So I love seeing that special sauce. Crowdfunder in our fund, we've actually changed our model that we're not focusing on picking winners. At the seed stage, like Dave, we're focused on putting money into companies that have a chance of being winners. So our focus is actually about picking great investors, and that's what we've done with our venture fund, the VC Index Fund. We take 50 top performing VCs, and we automatically invest in the deals they invest in. So we're crowdsourcing that intelligence.
50
great
top
investors.
performing VCs? So you have to like start with 1,000 VCs to get 50 top performing VCs.
So I have to agree, just to interject on the sentiment. For me, it's as we look at investments, it's definitely that id quality, and people. I mean, I have to believe that the person we're investing in is clever enough, given the stage that we're all investing at. There's so many zigs and zags in the road to get to the ultimate outcome that person has to be clever enough to not lose our money. But so next question. I know it's a little bit of a loaded question, but many people think that this time period is very similar to kind of 2009, 2010 in terms of starting a venture firm and investing in venture asset class. Agree or not agree?
What was the question, sir?
Is this a good time to be investing in venture? It's similar to 2009, 2010. Good time for the asset class.
I think there's no better time. I believe in the long-term game of the returns that you're building. In 2008, 2009, you had some companies that were really, really low on revenue. What you see is companies that are absolutely crushing it, that have great sustainable businesses and rapid, incredible growth. So I think this is markedly different than that time. If you just look historically at VC, VC's had about a 15% return rate overall, but at the early stage, if you invest at seed, there's about an average 30% IRR to that, actually 28%. So that's really where we focus in getting that value, investing very, very early, but it's really risky. I think the stats are 1.28% of venture-backed companies at the seed stage go on to become unicorns. So you can do a lot of things with that. What we choose to do is radically diversify, so we're on average 10 times more diverse in the number of deals that we're investing in from a fund than a typical VC. A typical VC will invest in 30 to 40 deals per fund. Our target is minimum 300 deals per fund. So we're really, really bullish about the early
Why not
stage.
go for 500?
Yeah, we're going to be 5,000 startups. Right?
Troy, what do you think?
I wasn't investing in 2008, but just kind of looking at mobile penetration globally right now, the fact that people are comfortable making purchases on the internet, and I just think it's a much different time, just in terms of the entire ecosystem. Mm-hmm. So I don't know if you could I don't know if it's fair to compare the two based upon the differences in the size of the market.
Interesting too.
2009 was a great time to be investing. That was when everybody else was sitting on our hands. When I was working with Peter Thiel at Founders Fund, we invested in what became Lyft at a $3 million valuation out of the Facebook fund. We invested in Twilio, now a $1 billion company, at a $3 million valuation. We invested in Credit Karma, now a $3 billion company at a $5 million valuation. So it was a great time because everybody else was scared and there wasn't a lot of money in the market and talented entrepreneurs were not getting capital. Unfortunately, I don't think it's at all like 2009. So there is, a slight pullback in the last quarter. There might be more pullback coming, but there's still plenty of money out there for great companies. So I wish it were as bad as 2009. We might be able to find some more unicorns, but I don't think that's what's going on right now. The reality is that like the rest of the finance community sort of woke up and realized that venture capital can actually make money. And over the last 5 years, seeing Facebook and Twitter and LinkedIn and Uber and a bunch of other things come out, they're like, holy shit, we should actually start looking at this tiny little asset class called venture capital and see if we can actually enlarge it. And a bunch of people piled into the market. They gave way too generous valuations. The whole unicorn stuff started happening. That doesn't mean that the initial recognition was incorrect. The recognition is, hey, some of these companies get started and actually can be multi-billion-dollar entities, and actually they don't have to go public. So if people write those big-ass checks, they are going to see potentially lots of value that was previously captured by the IPO markets, which now is not being captured by the public markets. They were probably a little too generous on that valuation over the last couple of years. They're sort of waking up and realizing what's going on.
Yeah, so I've been in and out of venture at various different stages of my career as a junior person and now as a partner. I started out at Battery Ventures in '99 at the height of the bubble. I went back in after I took on a bunch of debt for business school in 2004.
We all make mistakes.
I know, in 2004. And so it is interesting because I'm the newest partner to the fund, but in some sense I've actually sat through a bunch of cycles. So I joined at 23 in '99. And height of the bubble, made $100 grand on paper, getting pre-IPO stock in a company called Acumen back then. Thought everything was easy, and then the world collapsed. And at the age of 24 or 25, I was given my 2 first board seats and told to cut costs, fire CEOs. I had no idea what I was doing.
Fun.
Yeah, it was fun. But a lot of some of the companies I was given to babysit after I got back from business school and that everybody thought were sort of DNR, they ended up going public and doing quite well. And so I tend to agree. I don't think it's like 08, 09. I was not in VC in 08 and 09. I was in a public company. But I think there's some things that are like 08, 09 in the sense that things have become more rational. You can take your time. You can sit with things. You can do due diligence. You can look at cohorts and economics and all of those sorts of things. You don't have to make a decision in 2 weeks to just invest in this moment in time. So that's a positive. I think it's different in the ways that Dave discusses it as different in that there probably, it's going to be how do we help our portfolio companies move through this time where there are already big pockets of cash and capital structures need to be changed and teams need to be right-sized and focused. And so I think there's just a lot of hands-on work that's going to happen with all of the money and companies that are out there. And from what I've observed in the past, it's picking and choosing where you have the most data around your portfolio, where not to listen to the market and continue to support companies through those moments in time, and where to say, maybe we made a mistake and we should move away from it. That will probably create a lot of very big winners, but I'm not sure they're new companies. I think it's going to be, some new companies, but a whole lot of spending time with companies that are already out there.
I think it's a great time. I'm not an expert in capital markets, but as I perceive the sort of greed-fear cycle, that's always happening. And what sort of undulates underneath it is the level of fundamental technology that exists to be harvested to really improve human life. Right now, I think there are some enormous basic advances that we have technologically that are going to fuel an incredible amount of innovation. Cloud supercomputing, the proliferation of mobile devices, as Troy pointed out, our increasing ability to engineer biology, which may end up being one of the greatest industrial vectors in human history. These are all amazing tailwinds for people who are starting businesses that leverage them. And to the extent that entrepreneurs find creative ways to turn that technology into real economic activity, it's not only going to produce great returns, but will also enhance humanity's productivity and the size of our economies. Yeah, so I think these are all, and we're about to have several billion people come onto the grid for the first time ever, which has to be the biggest change of the next decade. So I find it impossible to imagine that between those demographic trends and the underlying technological trends, there aren't going to be trillions of dollars in new value produced. The question is, where do you find it, and at what point do you back things?
Absolutely. So Chance, with crowdfunding, the Jobs Act, more and more VCs, how do you, and just an ever-changing landscape, how do you see all these changes affecting companies?
So there's a massive sea change happening right now across all of finance. At the later stages and in public markets, we have things like Wealthfront that are taking robo-advisors and replacing humans and adding artificial intelligence to create a lot of value for people and raising AUM that it's taken other banks many years to get, and they've done it in a year. At the early stage of finance, you see really significant disruption, new policy. That's part of what I worked on in Washington, D.C. about 5 years ago, was a set of legislation as part of the Jobs Act that changes early stage investing, moves it online, and opens up and makes a more inclusive model so that not just wealthier people, but everyday people can participate and invest in a startup if they think it's great. So for a founder, there's never been more options out there. And I think that can also be a challenge for them, even though it's a huge opportunity. So what we see right now are some mega trends, similar to what DA was just talking about. In life sciences, there's incredible tailwinds that people can latch onto and grow a market. Right now we see crowdfunding, for an example. It's grown from virtually nothing in 2006, 2007, all the way up to a $34 billion industry in 2016, that's the estimate. That's as large as VC has been on average. So you have something that didn't exist 10 years ago that's already as large as the current venture capital market. So you have VC at 30 or 40 billion, you have angel investing at 20 billion. What happens is crowdfunding and this new portion of crowdfunding called equity crowdfunding is now doubling year over year, and is bringing not just a centralized LP capital market in, but a completely decentralized global online economy, a new capital market online. That's creating a giant new wave of opportunity for both investors, existing and a new class of investors, as well as opportunity for entrepreneurs to say, if I have a great idea and I am making traction, I have the ability to get that out in front of hundreds, maybe even thousands of people, and not just everyday people who are dumb money, but distribution to really great, really smart people. And so that's become our model at Crowdfunder. We take some of the best venture-backed deals and we allow other people to follow along behind great investors, great people like Dave, great people like Troy, everyone up here. And that's our model we're really excited about. How do we let other people participate in that? So it's not just someone who can buy Facebook stock after everyone's had their fun with it in the private markets, and they can buy in on the public markets. How do you allow everyone to invest at the early stage?
Dave, since you invested in over 500 companies last year, I'd love your take on that, and just also what you obviously invest not only in the U.S. but around the world. How do you see those changes specifically, and also just kind of the global landscape?
Well, I think the story that's been happening over the last 10 to 20 years is that costs of building companies, at least in their first few years, have come down dramatically, and the market's increased dramatically. But I think most VCs are probably focused on either the US market or the Chinese market, maybe the Western European market. There's not very many folks looking at the rest of the 5 billion people in the world. And sort of biggest interesting geographies for us are really Southeast Asia, which is like growing rapidly, India, which is growing also quite rapidly, and then starting to look at Middle East and Africa. These are markets with hundreds of millions of people and individual countries that are hundreds of millions of people. They're all becoming mobile enabled, they're all becoming payment enabled, but there's an incredible dearth of venture capital in most of those markets. People have been talking about China for a long time. There's actually too much capital in China, and you have seen huge successes like the BAT companies, Alibaba, Baidu, Tencent, others. But there's plenty of really big companies being created in markets that people don't think about, like Nigeria or Pakistan or Brazil. People think that the Brazil macro picture right now sucks. I can tell you we've made 35 investments in Brazil. 3 of those companies are at 20x, 50x, and 80x bigger than when we invested. So,
do you think more and more VCs will ultimately, create a footprint outside the U.S.?
No, which is great for us. I actually think there's a very few number of people. Sequoia and Excel and a few others do invest globally. I think Rocket and Tiger invest globally. But most people, at least on Sand Hill Road, are going to invest, primarily in a 30-mile radius around Sand Hill Road, and they might dabble in New York and LA. but most of them are not looking outside the U.S. There are, definitely great investors. The Southeast Asian market has filled up quite a bit. Lang probably knows a little bit about what's going on over there. So in just the last 5 years, that market has exploded. They invested in a company called Grab Taxi that's an Uber competitor there that's now $1 billion company in less than 3 years. But I just think most VCs are lazy and actually not that innovative. What's kind of hypocritical is that we are surrounded by entrepreneurs who are innovating and scaling their businesses, and venture capital is this shitty little asset class with very limited innovation that's practiced mostly how it was invented 50 years ago. And we are not scaling ourselves, we're not creating platforms, we're not taking advantage of technology. There's probably like 5 or 6 companies on Sand Hill Road that are doing something interesting in the asset class. Most of them, I'm not shitting on the model, but I'm saying they take a lot of meetings, play golf, and invest in 2 companies a year. And that's just so fucking unexciting and unimaginative.
Some of us are building platforms.
Yeah, agreed. And we're an investor in AngelList and also an investor in a platform called AgFunder that's looking at ag tech specifically. There's lots and lots of innovation going on, but honestly, the US is 300 million people, even China's only 1 billion people. There's 5 billion other people around the planet who all have bought smartphones in the last 5 years. They're all gonna be online making payments in the next 5 years. It's a ridiculously big fucking market, and we're sitting here just focused on this narrow little place called Silicon Valley, which is extremely talented, but I can tell you there are tons of talented entrepreneurs all over the world that don't have access to capital. In the last 2 months, I've been to Thailand, Vietnam, Taiwan, Hong Kong, lots of interesting places where there's just not as much capital. Maybe Hong Kong there is.
So DA, you and I both share a passion for healthcare opportunities. And one of the things that's really unique about DA is through his personal relationships, he has access to basically some of the biggest innovators and thought leaders of our time. So how is your evaluating opportunities? Do you bounce off these ideas off your friends as you look at opportunities, and how do you leverage those relationships after you make an investment?
I try not to leverage them very much because I think of friendships primarily as friendships. And the one thing I've really gained by being fortunate enough to know some of the folks from in college, knowing Mark Zuckerberg to people like Elon Musk now, is that what I find common to all of the sort of biggest dogs is purity to what drives their business and their interest in doing what they do. I can't think of any of these folks who I know. I don't know Jeff Bezos. I imagine he's a financial wizard, having been at D.E. Shaw and then obviously done what he's done with Amazon. But pretty much everyone else who I've met at the top of the technology world is not financially driven and has a sort of world-conquering 30-year vision for what they do. If you look at Elon as an example, and one of the things that drew me to SpaceX, it's not hard to see how impressive that company is becoming. It has a very simple, singular mission, which is colonize Mars, and out of that fall out a huge number of very, very difficult technical problems. But if you look at that business, there are some amazing lessons to derive from it. One is that because of the ambition and complexity and difficulty of the problem they're chasing, they get all of these sort of free advantages. They can hire all of the best people and pay them less money than they were making before, and they'll stay to work until 11 p.m. every night. Then you sort of generate a ripple effect of goodwill in the world to the extent that what you're doing actually makes sense for the economy at large. So I try to find businesses that fit the litmus test that I think those entrepreneurs would hold themselves to. And again, it's really hard to find that because it's super, super rare. I have a huge amount of admiration for what Dave's doing or what Chance is doing, but I am taking more limited number of bets. And so the only way that I can do that is to really try and prioritize things that seem extremely important and extremely unique. And those are qualities that I find commonly amongst those sort of founders.
That's great. No, that's great. No, I mean, we share a similar friend group, and I always use our friends not for not for any specific ask ever, but just, they're always so smart, just trying to understand macro ideas and macro trends. So yeah, no, I agree. So Kara and Troy, both of you have a number of consumer-facing investments. How do you see that landscape changing with corporate VCs and the such?
You want to take it, Kara?
No, go, I mean, you well, start. We're chivalrous in LA.
I don't know how much the corporate VCs are gonna change the landscape, but what Dave tapped on is very interesting in terms of the macro change in landscape, and when you look at places like India, and you look at places like China, and you look at the biggest opportunities that have come out of those places, they're all founders who understand the local consumer it's this high level of cultural competence. So I think in terms of the opportunities, and specifically in America, I think it's going to be founders who really understand the shift in demographic that's happening here, and I think they're calling it majority minority, which doesn't make sense. It's just going to be majority in the next couple of decades. But so I do think when you look at opportunities for Latinos, you look at opportunities for African Americans and those sort of growing demographics, I think investors and corporations that really understand those consumers are going to end up being the winners.
And just to follow up, just to direct to you, since you've got so many entertainment relationships, what's your take on so many companies that do have partners with entertainers and how that actually works, and is that a good thing, a bad thing, indifferent? What's your take?
I think it just has to have a high level of authenticity. The ones that work, when you look at what Jessica Alba and Brian Lee were able to build with Honest Company, I think it was a high level of authenticity there. You look at what Dr. Dre and Jimmy Iovine were able to build with Beats by Dre. When it came to audio, is nobody with more credibility than Dr. Dre there. And having that partnership with Jimmy Iovine and then the additional partners that they brought on to be able to execute it. So I do think people take for granted how hard it is. And Dr. Dre wasn't putting out albums while he was building Beats by Dre. And Jessica Alba, was one of those people that's in the office regularly and really in the product. So it's not a hobby for them. So people who take it seriously and build good partnerships, I think it works. That's the only time. And Ashton is another good example of someone who did a really deep dive and probably knows product just as much as any VC out there.
Or better.
Yeah.
I mean, I guess.
What's your take?
I think sort of what Dave's saying and what Troy's saying are similar. And by the way, I agree entirely with Dave. Like, I think it's I wouldn't win at a model of like same white guys investing in the same white guys. It's just, and it's one of the reasons when I moved back to LA 8 years ago, I kind of felt this pull to be up in Silicon Valley and almost felt like I was making a professional compromise for what was important to me personally at the time.
And LA's blowing up. You guys have done a great job.
And I've come to believe, I've made 5 investments. I haven't made a single in the year and a half I've been back in venture. I haven't made a single investment in the Bay Area. It's a really important market. I'm up there all the time. Because it is sort of just in terms of like how do you build companies that scale? How do you think in the right way? How do you hire and change in the right way? Like that skill set combined with these skill sets all over the world is sort of what we're all trying to figure out. So as you take it to like whether it's LA, like I unfortunately can't travel all over the world. I would, because I have 3 small kids. So you also have to look at your personal business model and where your personal superpowers are and where you feel like you can scale your own model. And to some extent, LA is not quite Africa, but it's, if you look at the...
Concrete jungle.
If you look at the ratio of capital to interesting opportunities and interesting opportunities across industry, it's still dramatically out of whack. And it's one of the reasons I joined Upfront Ventures, because it's not just about Upfront Ventures, but it's very much about us having a chip on our shoulder as a city. How do we put LA on the map as the capital of innovation across all of these industries that are heavily represented here? So I went off topic a little bit, but if you look at corporates, and I've spent a bunch of time with corporates recently, in particular spaces where I spend a bunch of time, so food or education or manufacturing, and I invest in both consumer and business, and I kind of tend to look for the same things. It's sort of, how do you take real tangible industry skill sets, authenticity, like understanding, like 3D printing will change the world. It will. Will it happen in 2 years? Will it happen in 30 years? I don't know. We have $2 trillion out of our GDP that goes into manufacturing. We have a ton of manufacturing here in LA, from aerospace to toys. And so I've spent the last year and a half just trying to get to know everyone I could know in and around manufacturing, to figure out how is like the entrepreneurial spirit in manufacturing going to come together in a way that may change our economy. And the corporates tend to have a pretty strong and interesting view of this and be very helpful in diligencing and getting up to speed, where we may know something about entrepreneurship and how to build startups, but we know a whole lot less about how to completely restructure Disney's supply chain when they're getting into the consumer products business for the first time. Another one I just spent time with yesterday, Acres Ventures, guys that came out of Bolthouse Farms, which was sold to Campbell's Soup for $1.5 billion. They're fundamentally trying to change the shape of food from within one of the biggest food companies out there. They have a completely separate corporate structure, and they know more about food and have access to people who know more about food safety, preservative sourcing, policy than anyone else out there. So I do think there are really strategic ways you can spend time with corporates who can be really helpful as you're trying to figure out how to do things that aren't just going to be like the next dog walking app, but are going to go after some fundamental problems and opportunities we have in our economy.
That's great. So obviously, with more and more sources of funding, and I've had this conversation over the last couple of days, and the stages of rounds is continuing to change. For instance, we have a company in our portfolio that we were a seed investor in, that in the mobile payment space, Mozito, that went from a seed round to raising $70 million from Wellington in their A round.
That's an A round?
Yeah, that's an A round. It's exactly. How do you see these larger institutional players? I'm going to direct it at Dave first, because you see more and more.
Well, institutional, I think you mean people writing big checks,
Yes.
$50, $100 million and up. That's not, we play in the kiddie pool. We start writing $100,000 checks, and if we feel like things are working, we write $500,000 checks. But I think some of those distortions are calming back down. I would say, kind of what I was saying before is I think people overvalued those companies, and they thought with some kind of liquidation preference and billion-dollar valuations that they were safe. And I think people are realizing that's not true. But there is still a tremendous amount of growth happening in companies that have gotten to maybe 100 people, $10, $20 million in revenue, and seems like the business model is working. And I think what's happened is a lot of the traditional institutional venture folks who've been writing Series A and B checks have been selling this story to private equity and hedge funds and international investors that billion-dollar valuations are safe and are great. But actually, I think the real opportunity is probably at $100 million to $500 million valuations, which is where those investors are still putting money in. That's when actually a fair amount of risk is out of the model. Business model is already sort of established, and there's still going to be competitive risk in other things. But at multi-billion-dollar valuations, you can and will lose money. At $100 million valuations, when the companies have figured out the model, I think you'll lose money less frequently, or at least you won't be investing in quite such high-priced assets. So I think there's this pricing sort of education that a lot of investors coming into the market are trying to understand. Like, did I set the price too high for Dropbox at $10 billion? Well, probably yes, but it's not zero, right? And so figuring out where that is on the spectrum and investing at a proper sort of valuation to make money is what we're kind of all going through. I think our part of the spectrum is we're going to invest when things are extremely cheap. We're going to see a lot of failure. But out of 100 investments, we're going to find 5 that are potential unicorns, or at least potential $100 million companies. And we're going to get in really, really low and early. And I think that's what's exciting to me, is that sort of thesis and story is spreading in a lot of different places. And
Sarah, what do you think?
Yeah, no, I mean, I tend to agree. I mean, I think I think a lot of the challenge has been around sort of these companies that should be public staying private, and I just, it seems to me that with the number of things that have happened recently, whether it's Theranos or Zenefits or kind of all the cautionary tales that are out there, that there's a level of oversight and reporting and controls and things that probably should happen when you start bringing in that much capital at that level of valuation to make sure the company actually is what it says it is. And as
But Theranos wasn't a VC story, actually.
Yeah,
that was
well-
actually a lot of uneducated, non-traditional Valley money that came in and valued
Yeah,
that company way too high.
DFJ.
Tim put money in very small amount, just personally because he knew the company, but he didn't make a $10 million, $20 million bet out of DFJ.
But it's more to just and maybe that specific example wasn't the perfect example. It's more of like it's the Bill Gurley bell that he's been trying to ring, which is sort of you have.
On target.
Yeah, I mean, absolutely. It's you have a lot of capital at high valuations, people who are used to a certain level of compliance reporting, et cetera, and the companies aren't ready for it, and so.
But Bill's also been an investor in Uber and
Yeah,
several
sure.
other companies.
I would, I'll try out sort of a novel argument I've been thinking about, which is that one of the challenges here is that we are seeing the birth of certain companies that I would call Taj Mahal businesses. What I mean by that is, like, what's the value of the Taj Mahal? This is real estate in a new economy that is emerging, and some of these businesses are impossible to value by conventional approaches. What is Amazon worth? I don't know. The gas station at the end of my street makes more money at the end of every year. Today, I would rather own the gas station.
I think they made money in their
than
last
Amazon.
earnings. Yeah.
You'd rather own a gas station than Amazon?
Well, if I have to put
Shit,
food
give
on
me your Amazon shares. I want Amazon.
Listen, if I have to put food on the table, Facebook, Amazon, Google, these are extraordinarily important companies.
Yes.
And you can say, well, we could try and think about what one day when they cash flow, we'd value that at. But they're never going to do that as long as Wall Street allows them to keep taking more and more land in the future. And so, you would have made a fortune investing at Amazon's IPO or at Google's IPO. Right. Those, if they happen today.
That's what people are waking up to and realize. And the reason that people aren't going public is because the private market valuations were more generous. Why should they go public if people are giving them money at $10 billion, $20 billion valuations that's more generous than the public market?
Yeah, I mean, I guess it's not an absolute thing. It's relative to obviously what these investors think that they're going to get a return in alternative asset classes. And then I think that the other thing that's interesting is we constantly talk about the kind of lower cost to starting a business, and I think that's true when you're starting the business, but to scale a business, if you look at the capital efficiency of like Amazon or Google before they actually had some varietal of a business model relative to what we're doing today, I mean, it's...
But those were huge infrastructure businesses. We invested in Ipsy, which raised $3 million and then built a $150 million profitable business in 4 years because Michelle is great at social marketing on YouTube. And it's not the case that they needed $100 million they raised $100 million and took that out of the company.
But they were wildly profitable. Right, take that relative to Birchbox, though, right? Like
Exactly.
Profitable.
We spent
and
a lot less fucking money on building Ipsy to a big profitable business than Birchbox spent because they were stupid and inefficient about how they do the marketing.
Yeah.
Like, that's what's really also exciting is that people don't have to spend shit tons of money on marketing because you've got billions of people on Snapchat, on Instagram, on like YouTube, on Pinterest, on Facebook. Like, that's what's happening is not like product innovation all the time. I admit there's lots of cool product innovation, but what people are missing is marketing innovation. There's huge amounts of marketing innovation going on, and all these big public companies are idiotic at that shit. They don't know what's happening. They don't know how to recruit the right people to do that. And so the leverage in most of what we're doing is not coming up with the greatest new product innovation. Uber and Airbnb are not huge product innovations, or at least they haven't been to date. They're very basic transportation and hospitality applications. The innovation they made was in customer acquisition. Right? Most of that was just the marketing access and getting connected with your taxi driver or finding out the person who has a cool place to stay in a new city. And they're taking huge amounts of market share from big dumb companies because of marketing innovation, not necessarily because of product innovation.
So we've got a lot of family offices in the room, and one of the things, not everyone's family office has a sophisticated structure in terms of evaluating venture investments, but these groups see everything from their nephew's startup to participating in the latest round of Uber. How do you advise family offices? What do you think, Troy, in terms of how to approach that?
You know, well, what we were able to do is just really build out just great syndicates. You know, so for us, because we didn't have a big diligence team or anything like that, you know, it was being able to have relationships with other people who, similar to what Chance said, you know, great track records. Great diligence process, lots of experience, and then kind of marrying that alongside of our own diligence process and instincts.
Dave, I know you have some thoughts around.
I mean, I think LA is a really great market opportunity that we're starting to spend more time in, and I think Troy mentioned before, you know, the African American and the Hispanic populations in the U.S. is probably 30% of the population. Mm-hmm. It's not 30% of the founders. Mm-hmm. Like, that's a missed opportunity, not because of ethical or moral reasons, but pure greed and capitalism reasons. Mm-hmm. Like, a third of the country is Black or Hispanic, and I guarantee you we have not seen enough founders or enough businesses going after those markets. The ones we have invested in, Bevel and Maven, are kicking ass.
Yeah, for sure.
One last question before we open it up to our audience and everything. So you know, there's a lot of data around diversity in founding teams, and that it's associated with top performance. I'd love a quick input from each of you on just how you approach that, and is it something that you look at as well as do you look for a double bottom line in terms of social impact as well?
I think the Valley made up what's the terminology, unconscious bias, and we used to call it racism. So that's the new.
Some people are conscious of it.
Yeah, exactly. I'll go. I can go an hour on that.
I would say, you know, in our world, there's actually really interesting data, at least from the participation side and backing side. In general crowdfunding, we do equity crowdfunding for investment, but in general crowdfunding, the data showed that 40% of participants, backers, are female. And they more often back females. Same is true for female investors. 7% of VCs partners are females, but they much more often back females. So there's a really great case for involving the investors in the equation, not just, hey, how do we find more backers? You have to go upstream to fix the problem. You can't just look at the bodies coming downstream and say, hey, let's try and revive that body. How do we go up market? How do we systemically address this? Of course, there's a better conversation in a room, and there's a diversity of ideas and approach. So what we're doing at Crowdfunder, our VC index fund has a mandate on diversity and inclusion. Right now, we're at 40% of the founders are female or minority, and we understand that that's going to drive better outcomes and performance over time.
But one of the issues, though, and this true story happened 3 weeks ago. We had a meeting with a Silicon Valley LP who ended up, you know, being very, very honest. And he said, I was talking to another group of LPs that were looking at your fund, but they were reluctant to invest in the fund because they thought you were changing your strategy and that you wouldn't be looking for that next Uber or Lyft or Spotify, and that you were only going to invest in African American founders. So I said, who said an African American founder can't build the next Uber, Lyft, or Spotify? But I was happy with his candor, but it just shows you that, like, I think we have to have Black VC funds in order to be able to look and spot these opportunities. Because to your point, Dave, looking at
that's why we hired Monique.
But it's true, because Maven's a company that both Dave and I invested in, and this was a company that was going after a $9 billion U.S. Just the hair category for African American females in the United States was a $9 billion category. But yet, when I found myself having to explain the deal to other VC firms because they didn't understand the market.
Small secret, I went out with someone Black in high school, which is why I had some familiarity with that. And I think Ben's wife is Black, which is why Andreessen did that deal. But most VCs.
They didn't understand
This
the
is a fairly diverse panel. Only 4 of us are entitled white males. If you look at the other panels around here, it's like all male panel, all white male panel. But
And creating
there were
more mentorship.
like Maven was crushing it on revenue. That company should have been valued at 2.5 times what the pre-money was on that deal, and it took them 3 years to get that deal done. There's no reason why that shouldn't have happened so much faster and earlier.
Tara, I'd love your take, and then we'll open it up to questions from the
Yeah,
audience.
so I guess cognitive bias also used to be called sexism. But I think it's a real thing, right? And I always think about it as a little bit Darwinian. It's like the people who didn't look like you a long time ago you thought might eat you. So you had to be careful and spend more time maybe with the people who look like you. I don't know, but it's interesting because I don't feel like I grew up as a minority. I'm like a white kid from the San Fernando Valley. But now in this industry, I apparently am a minority. I'm deeply passionate about diversity as a mission, but I find the best way to make an impact is to make sure the data works, and the data works, so that's the good news. So I joke around that I like to fund diverse teams or white men with high EQs who will get there.
That's a tough bet.
I've funded 5 companies to date. 3 of them are run by female CEOs, so small portfolio, but 60% of it is female-led. Am I more likely to back a woman? Probably. Am I more likely to understand when we're talking about women's health and nutritional supplements when you're pregnant, what that means? Probably. And I do think that I think it's a really big issue that venture capital is primarily composed of white men. And I think we need to fix it, and I think that's a whole long conversation. It's a very
And creating more
long
mentorship
feedback loop.
opportunities.
Asset
and-
class, there's no Google dashboard you can look at every day. Markups and unicorn valuations may or may not mean something as an asset class, and I'm sure it'll perform, but it's fundamentally adversarial. There's a whole lot of things about it that make it harder for it to become diverse, but I think it's a topic that people are chipping away at, and I'm optimistic and excited and hope to play a small
Yeah, I'd just
role.
say it's a huge advantage to not be sexist and racist in this market because the prices are low.
Actually, that is true. That is actually true.
When I consistently
Totally true.
try to pursue companies with female founders, minority founders, founders who are immigrants with weird accents, anything that might turn off biased people and result in a better deal. Is something you should do purely opportunistically. The last thing I'll say, just on your question about family offices and how they should think about this, I was at an impact investing meeting yesterday here, and one of the things that was frustrating to me about it was it's like all investing should be impact investing. Like the actual goal shouldn't be to increase the minority share of impact investing. It should be that we convert the regular economy into one that prices in negative externalities for our environment and bad things that companies routinely do to make money. And so I similarly would like to see family offices, traditional investors, inspired by the excitement, energy, and culture of Silicon Valley to be motivated to invest in more innovative business opportunities. I think the entire economy will be better if more of the capital markets are focused on innovation, generally speaking. And right now, most of their energy is attending to moving money around in zero-sum markets.
Absolutely. Well, real quick, let's take a couple of quick questions. We have them from the audience. Margaret?
So I wondered if you could talk a little bit. You talked about all these different demographics in terms of both investors, but what you're investing in. And then Dave, you really kind of jumped in there on the marketing aspect, specifically about Ipsy versus Birchbox. I have a 13-year-old daughter. She's an Ipsy fan, and she's sort of this, one of these little hip kids that sort of tells everybody what they should think. And
Great.
I'm
So you want a
curious-
job as venture capitalist?
Right. I'll hook her up with you. So I'm curious, though.
I'm
with
kind of
the-
serious.
the people under 20. So we've talked about international markets and all of that,
Yes.
but can you talk about this marketing aspect of, sort of this younger, future consumer demographic? I mean, another thing I watch in her cohort is Starbucks is doing an amazing job, brewing their next set of customers, right? So moms and dads are thrilled when their kids are like, "Can I go out to Starbucks?" And you're like, "Here's a 20." Off you go. Like, see you in 3 hours. Go ahead, have a few lattes, whatever you need. And they're totally.
I don't think this is just people under 20. I think actually all of us operate.
That's that marketing aspect and then the younger sort of demographic in terms of what you're investing in?
So we have a 25-year-old on our staff who's going to be running a fashion and beauty fund for us, and she gives me tips on how to do Snapchat because I'm going to be 50 this summer. I'm not quite as young as I look. But I think it's not really a big surprise, right? You look at how Home Shopping Network or other things on TV are actually great channels for selling products. You may not like, the products that they sell or the methods that they use, but they're very successful. And kind of looking at ways to use visual platforms on mobile devices to sell is kind of straightforward. Pictures, videos, eventually virtual reality and augmented reality are going to be better ways to communicate to people about products.
One last question, because if we're real close on time. Sir.
Dave's point about the preponderance of the world's venture capital being concentrated in the United States.
And China.
And China. If you're an entrepreneur not in China and not in the United States, how
Life
can you
sucks.
bring yourself to the attention of this rather tight circle of the preponderance of the world's VC?
White guys on Sand Hill Road probably aren't going to care. I think you need to develop those from local markets. So I was just in Thailand last week. The government just announced a $550 million budget to allocate to startups, but they don't necessarily know how to spend it. I think looking at how venture capital got built in the US, which most people tend to forget, that venture capitalists was really a subsidized by the government industry. That was an entitlement program. In the 70s, 80s, and 90s, probably 70s and 80s, a lot of government money went to kind of match the initial venture capital firms that were getting off the ground. So structuring fund-to-fund entities, figuring out how to create seed funds and Series A funds, looking at liquidity strategies. It's going to take a while, but the opportunities are tremendous.
Awesome. Well, thank you very much. Appreciate your time. Thank you, everyone. Appreciate